Welcome back. Towards the conclusion of the last lecture, I introduced the concept of conversion factors. I will discuss this with reference to the Chicago Mercantile Exchange, the futures on T bonds that are traded on the CME, but the concepts that are used therein are more or less universally adopted with adaptations. As on a particular date of delivery of relating to a T-bill futures bond futures, there can be a number of bonds that can be tendered for delivery by the party enjoying the short position. In fact, the requirement is that any bond having a remaining lifespan of 15 years and which is not callable within that period of 15 years can be tendered for delivery by the short party to the long party under the futures contract. That means that a variety of bonds can be delivered. So, there has to be some mechanism by which the equivalence between different bonds has to be arrived at, because the bonds that would be trading at that point in time and that could be tendered for delivery would be varying in terms of maturities, would be varying in terms of coupon rates, and therefore, would be varying in terms of yields as well. This equivalence is arrived at in terms of a quantity which is known as the conversion factor. The conversion factor equates the value or the worth of the bond which is proposed to be tendered in relation to what is the standard bond. The standard bond is computed on the basis of a yield which is presently at 6%, but which of course is again fixed by the exchange and varies from exchange to exchange. Now, but there is an algorithm by which these conversion factors are arrived at. The algorithm consists of a number of steps. Let us look at those steps. The steps involve, number 1, the rounding off of the tenure of the bond, then identifying the coupon dates, discounting the future cash flows to arrive at the intrinsic value of the bond, and finally deducting the accrued interest if it is applicable. I will explain this with reference to 2 examples, but first of all let me go through these various steps. The first step is to round down the tenure of the bond. The emphasis is on rounding down. That means what? That means any bond which this is to be done on the first day of the delivery month. All this process relates to the first day of the delivery month. That is the first thing. The second thing is, on the basis of the remaining tenure of the bonds, we round it down to the next lower quarter. For example, if a bond has a remaining tenure of 18 years and 4 months, the tenure will be rounded down to 18 years and 3 months. If it has a tenure of 18 years and 5 months, it will still be rounded down to 18 years and 3 months. And if it is a tenure of 18 years and 7 months, it will be rounded down to 18 years and 6 months. So, the next lower quarter is the point at which the process of determination of intrinsic value takes place. So, the first step is rounding down. I emphasize again, it is rounding down to the next earlier quarter, next lower quarter. Now, this leaves us with 2 options. One option is that after the rounding down process, the tenure of the bond turns out to be an integral multiple of 6 months. And the second situation is that after the rounding off, it does not become an integral multiple of 6 months, it has 3 months plus integral multiples of 6 months. One 3-month period and then an integral multiple of 6-month period. The 2 cases are handled in slightly different ways. The first case is quite simple. The first coupon is assumed to arise at the end of 6 months from this date. Which date? The date, the first day of the delivery month. So, the first coupon is assumed to arrive or to be delivered at the end of 6 months from today, which is the first day of the delivery month. And thereafter coupons are taken at regular half yearly intervals. So, let us look at this example, it will clarify it more. We are having a 10% coupon bond with 20 years and 2 months to delivery to maturity. So, the first step of rounding off gives us 20 years, and because this is an integral multiple of 6 months, because it is an integral multiple of 6 months, the first coupon will be deemed to arise at 6 months from today, and therefore, the intrinsic value is worked out accordingly at an yield of 6%. So, if you look at this equation here, this equation here clarifies everything. The bond is a 10% bond, that means half yearly coupon payments will be of $5 or 5 units of money each on a face value of 100. So, this 5 represents the half yearly coupon payments, and because there are 20 years to maturity, after rounding down there will be 40 such payments, and 6% per annum compounded half yearly amounts to 3% for the half year period, and so we are discounting it at 3% over 40 discounting periods, each consisting of half years, and therefore, each using 3% as the discounting rate. So, this is the present value of the coupon payments, present value of the coupon payments. Then of course, we have the principal as well, we are assuming the face value to be 100. So, the principal repayment will be 100 divided by the present value of the principal repayment will be 100 divided by 1.03 to the power 40, because it is going to be paid 40 half years later. The total works out to be 146.23 per 100 rupees of face value. Therefore, for 1 rupee of face value, we arrive at 1.4623, which gives the conversion factor in the case of this situation. So, in the case of a situation when after rounding down, let me recap. In the case of a situation when after rounding down we arrive at an integral multiple of 6 months, the first coupon is assumed to occur at the end of 6 months from now, and thereafter coupons are assumed to arise at 6 monthly intervals over the remaining life of the bond after rounding down, and the intrinsic value is calculated accordingly at a yield rate of 6%. 6% per annum compounded semi-annually, that comes to 3% for each semi-annual period, and divided by the face value of 100, you arrive at the conversion factor. Now, we look at the second case, when we have a situation where after rounding down we have integral number of 6 monthly periods plus an extra 3-month period. In that case, the first step, let us look at this example, it is an 8% bond with 18 years and 4 months to maturity. 18 years and 4 months will be rounded down to 18 years and 3 months. So, 18 full years, that is 36 6 monthly periods plus an extra 3 monthly period. So, in this case the first step is to work out the coupon date, and we start with a coupon date or the first coupon arising at 3 months from now, 3 months, and thereafter 6 months over the remaining life of the period of 18 years. So, this is, that means what? That means from here we have 18 years and 3 months, 18 years 3 months, this is 3 months. So, this remaining is 18 years, this remaining period is 18 years. So, as far as this period is concerned, period A B, it works out to 18 years, and we start with a coupon payment at the beginning of this period of 18 years, and thereafter we have 6 monthly coupons of how much? Of 4 rupees or $4 each. So, let us work, the first step is to work out the present value of all these coupons and the principal repayment at point A, and that is given by, we have one coupon at t equal to 3 months, which is 4. Remember, we are working out this value at t equal to 3 months. This is the value PV, present value at t equal to 3 months from today. Therefore, the first coupon arising at t equal to 3 months will not be discounted, it is arising at t equal to 0 with respect to this. So, it will not be discounted, and then we have 36 coupons spread over the remaining 18 years, and we have the present value of this again compounded or discounted at the rate of 6% per annum, 3% for the semi-annual period, and this is the present value of the principal. This entire thing works out to 125.83. So, what is this figure? This figure is the present value of the bond worked out at t equal to 3 months from now. It is not at t equal to 0. I reiterate that it is not at t equal to 0, it is at t equal to 3 months from now. We now need to bring it back to t equal to 0. We use this expression for bringing it back to t equal to 0. The effective rate, using the effective rate of 3% per half year per 6 months, we arrive at the effective rate for 3 months and we discount it accordingly at the effective rate, that is 1.4889%, 1.4889% for the 3 month period, and bring it back down to t equal to 0. Please note, we are doing discounting here not on the basis of simple interest expression, we are doing it on the basis of a compounding factor. In other words, we are using this expression for working out the effective rate for 3 months. Now, this is as per market practice. Some of you may argue, no, that we should use it, we should use 1.5% instead of 1.4889%. Well, this is based on market practice. So, this is the way we work out the interest rate for the 3 month period. It comes to 1.4889%. We discount this at this rate for 3 months, discount this quantity at this rate for 3 months, and we arrive at this expression. So, this is the value of my bond, this is the value of my bond at t equal to 0. This is the value of my bond at t equal to 0, but there is one more thing to be considered. Now, this quantity, if you look at this quantity, this interest of $4, how much period does it relate to? It relates to a period of 6 months. We are remember, it is an 8% bond. So, this 4 rupees or $4 is interest for 6 months, but we are compounding it at t equal to 0, that is 3 months from now. In other words, this interest includes the interest for the period of, let us say, t equal to -3 to t equal to 0 months. Let me explain further. This $4 amount is an interest for 6 months. So, it must relate to this point, which is t equal to 3 months, t equal to 3 months to t equal to -3 months. We are doing the computation at t equal to 0. That means, the value that we have arrived at, the figure that we have arrived at, includes accrued interest for the period from t equal to -3 months to t equal to 0, which is nothing but $2. So, $2 have to be deducted from this to arrive at the actual worth of this bond at the point t equal to 0, which is 121.99. You divide it by the face value and you arrive at 1.2199, which is the conversion factor in this case. So, the important thing here is the rest of it is relatively simple. The important thing is to deduct the accrued interest for 3 months, because the first coupon that we are using relates to the period that has already expired of 3 months plus the period that is yet to expire of 3 months. Therefore, we need to deduct the interest for the period that has already expired, which is of 3 months, that amounts to $2 in this particular case. This is how the second case is to be handled in the case of not being in the case of the tenure not being an integral multiple of 6 months after rounding down. So, having explained the concept of conversion factor and knowing fully well that there can be multiple delivery options for the short party against a particular T-bond futures contract. It sometimes happens due to market aberrations that some particular bond delivery turns out to be cheapest for the short party. To understand more about it, let us look at this. The short party, on delivering the instrument, underlying instrument on the maturity date, on the delivery date, what does he receive? He receives the settlement price multiplied by the conversion factor. Why? Because the settlement price is quoted in terms of the standard bond. So, whatever bond he is going to deliver, it will have a conversion factor if it is not the standard bond. So, if multiplying the settlement price with the conversion factor gives us the cash in terms of in relation to the delivery of the bond, plus of course, we have the accrued interest for the period which has elapsed. Now, in order to deliver a particular bond, the short party will acquire the bond or will purchase the bond from the market. Now, the underlying instrument, the bonds are not quoted in terms of conversion factors, they are quoted in terms of their respective worths. Bond A will have a certain quotation, bond B will have a certain quotation, bond C will have a quotation depending on their parameters, yields and coupon rates and maturities and so on. So, as far as the short party is concerned, when he acquires the bond, the price that he has to pay is the quoted bond price. No issue of conversion factor here. The quoted bond price, because this relates to the bond that he is going to buy, whichever that bond is. The quoted bond price plus the accrued interest. So, obviously, this is what he receives and this is what he pays. Now, he will obviously select that option because he has a choice. He will obviously select that option for which the pay minus receive is the lowest, or conversely receive minus pay is the highest. So, in other words, short will deliver that bond of the multiple options that I have, for which the quoted bond price, this accrued interest cancel with each other, quoted bond price minus MRSP into conversion factor is the least. Let us take a small example. The settlement price is 93.25, the short party has 3 options 1, 2 and 3. The quoted bond price is given in the first column 99.50, 143.50 and 119.75. These are the 3 bonds which are being quoted. These are the bonds being quoted, these are the underlying instruments, quotes of the underlying instruments, not of the futures. Futures are quoted at this, and this is for standard bond. This is per standard bond and this is for the underlying instrument. Conversion factor is this quantity. Now, if I deliver this bond, the money that I am going to receive from the long party is given by this into this, MRSP into conversion factor, that turns out to be 96.81. But when I buy this bond in the market, I have to pay 99.50. So, I incur a net loss of 2.69. In the other cases also we work out similarly, and we find that in the case of bond number 2, the loss is the least, and therefore, it is the cheapest to deliver bond. This is the concept of cheapest to deliver bonds. Now, before we conclude the futures discussion on futures, there are 2 important things that I would like to emphasize or recap or reiterate. Number 1 is the maturity of futures versus maturity of the T-bill or the euro-dollar deposit, as the case may be. You see, maturity of the futures relates to the period 0 to T. At the point T, a particular instrument is delivered and that instrument has a maturity of this period T to N. At N, the instrument will mature and you will get the face value of the instrument. If, for example, if you take a T-bill future, a T-bill future may be contracted to be delivered. Now, this is a futures agreement, it may be contracted to be delivered at a particular price at a particular point, and that particular point is T. At point T, what you get is a 90-day T-bill or a 91-day T-bill, as the case may be, 92-day T-bill, whatever it is, whatever the exchange specifies, but you get a particular tenured T-bill. On the expiry of the tenure of the T-bill, you get the face value of the T-bill credited to your account. So, the important thing is this period T and N is usually 90, 91 or 92 days, as the case may be. In US you have 90, 91, 92 days. In India we have 91-day T-bill. So, in India this would be 91. In US this could be any of these three, depending on the specifications of the futures contract. However, the important thing is that this need not be 90, 91, 92 or 95 days. As we discussed in an earlier lecture, in the case of euro dollar futures, this could be as far back as 10 years. In other words, we have contracts available for trading, quarterly contracts available for trading over a period of 10 years, over 40 quarters. So, in other words, as of today, you can lock the forward rate for a loan that is to be initiated 10 years from now. So, this period need not be 90, 91 or 90, it has nothing to do with this period. They are two independent periods, but they are nevertheless determined by the exchange. In euro dollar futures, this can be as long as 10 years. So, that you have to keep track of, that is important. There is another issue of the day count or tick size. Let us get into it. We have been emphasizing, we have been discussing that the actual price of trade is given by this expression, face value into 1 minus the futures yield, whatever the futures yield, into 0.25, 90 upon 103 and 60. My emphasis here is again that this quantity, for at least for academic interest, although this quantity again is specified by the exchanges at which they are traded. Again, this is a matter of convention or a matter of the contract of issue or the method of specifications by the exchanges, but for academic interest, this quantity need not necessarily be 90 upon 360. For example, let us look at a situation where this quantity is 0. If this quantity is 0, what does it mean? It means that the trade price will be independent of the yield over the life of the futures. If this expression, that is this theta is 0, that means delta p will be 0. That means the change in price over the life of the futures will be 0. But as on the date of maturity or the date of delivery of the futures contract, the futures price, due to convergence, due to no arbitrage, due to convergence or no arbitrage, they are synonymous literally in this context, but it must equal the spot price of the underlying instrument, spot price of the T-bill. If that is so, and the price has not changed over the life of the future, that means what? That means there will be only one marking to market, and that will occur at the date of maturity, where the initial price F0 at which the contract is initiated will simply jump discontinuously to the spot price prevailing on the date of. And if you increase the theta, for example, if you increase the theta, what is happening? You are increasing the transfers to the margin account. You see, the basic thing is the amount F0 and there is ST or SN, whatever you like, ST, this differential has to be transferred to your margin account, positive or negative. Now, how this is transferred is governed by this theta quantity. If theta is 0, it is transferred in one go as on the date of maturity, and if theta is this, it will follow a certain pattern. If theta is increased, then the volatility of the transfers in the margin account will increase. If theta is decreased, volatility will decrease. So, it is simply a measure of volatility. So, that is one thing. Theta is not God sent, it is created by the exchanges, and it is not sacrosanct. That is the important thing. The second thing is, even if you want to retain the same level of changes in prices, let us say you want to retain the same level of changes in prices, you can rescale your tick size. You can rescale your tick size and have a different theta. You can rescale delta y. You can say, for example, if you have a tick size of 1 basis point, it translates to $25 for a US T-bill futures. Instead of that, if you convert it to 0.5 basis points and instead of 90 you make it 180, you still have a price change of $25 So, again, by rescaling both of them, you can do the same price change or same tick in terms of price change. So, again, that is also not sacrosanct. It simply asserts and ascertains the volatility of the transfers to the margin accounts. Right. Now, we come to a new topic. We talk about option contracts. We discussed in length about futures. Let us now take up option contracts. What is an option contract? An option see, every contract has two parties. An option contract also has two parties. There is one party called the holder of the option, there is the other party called the writer of the option. One party is the holder of the option is also called long in the option or having a long position in the option, and the writer of the option is said to be short in the option or having a short position in the option. Now, the party that is long in the option has a right, has a discretion, has the power to buy or sell, buy one type of option, sell another type of option. We will come back to it. Buy or sell an asset at a price which is predetermined, and that option can be exercised at a point in time or within a time period. So, there are too many ifs and buts here, but we will analyze each of them in detail. But the basic thing is that he has a right, that is the fundamental thing. He has a right, he has a right to buy, let us forget the selling part. He has a right to buy an asset at a point in time in the future at a price which is determined as of today. What happens to the other party? The other party has no right. A has the right, B has no right. B has the obligation that if A exercises the right, now remember A has the discretion whether he wants to exercise the right or he does not want to exercise the right. If he exercises the right, then B has the obligation, he has the duty that he must satisfy his leg of the contract. And what is his leg of the contract? He must deliver to A the asset which is the substratum of the contract at the predetermined price. So, that is how the option contract operates. One party has a right, the other party has the obligation. One party, you see, in the case of forwards, in the case of futures, we never talked about a differential between two parties. Both the parties had their respective obligations. Both the parties were required to meet their respective requirements under the contracts. However, in the case of an option contract, the name itself signifies it. In the case of an option contract, there is an option, there is a discretion. The discretion is with one party, he may exercise the option, he may just let the option lapse, he may simply do nothing. But if he decides to exercise the option, then the other party's role comes into play, and the other party's role is to honor his obligation under the contract. You will say, what is so great? What is so great about party A that he is having a right, and why the poor party B is being victimized? Well, for getting that right, A will pay a certain price to B. It is not that there is nothing called free lunch here. A will pay a certain price to B in order to acquire that right, that is called the premium or the price of the option. By giving that price to B, he acquires the right from B, that if he exercises the option, B has the obligation to do it. Okay. Now, some nomenclature. We have got two types of options, the European option and the American option. As I mentioned, in terms of points of time, an option may be exercised at a given point in time, at a given point in time, in which context it is called a European option, or it may be exercised up to a given point in time, in which case it is called an American option. European option can be exercised at a given point in time on a given day. American options can be exercised up to the date of maturity, up to the given day. Then I mentioned about the right to buy and the right to sell. The right to buy, an option which gives the holder of the option the right to buy the asset, is called a call option, and an option that gives the holder of the option a right to sell the asset is called a put option. Right to buy, call, right to sell, put. Underlying asset, the substratum of the contract, in other words, the asset that is to be bought or the asset that is to be sold is called the underlying asset. It can be as in the case of futures and forward, it can be anything, it can be commodities, it can be currencies, it can be stocks, it can be indices, it can be interest rates, and it can be even electricity. So, there is a wide spectrum of assets on which options have been created and traded. The strike price and the exercise price, the price at which, as I mentioned that options give the right to buy or sell at a predetermined price, that price is called the strike price or the exercise price. And the date on which the option, in the case of European options, the date on which the option becomes exercisable is called the date of maturity or the expiry date. Similarly, in the case of American options, it is the date up to which the option can be exercised. We will continue from after the break. Thank you.